everyone, Tom Bowman here, and this is Strategic Investor Insights, where my goal is to try to make complicated investment topics a little bit easier to understand. In this first series, I hope to cover a topic that seems a bit underserved in the investment planning community, and that is a concentrated stock position. While I plan to do a whole series on equity compensation, which is a lot of times how people create concentrated stock positions, I want to focus this video and series of videos on the concentrated stock position itself and some of the options available to you. Now let's first talk a little bit about what a concentrated stock position even is. What that means is it's one stock in your total net wealth or your total portfolio that covers more than 10% of your entire portfolio or your entire net wealth. So for instance, maybe I have some real estate or other interests, but if I add everything outside of my residence up, and that one stock covers more than 10% of that total number, I'd have what's considered typically a concentrated stock position. Now, I might have gotten this concentrated stock position from purchasing a stock at a low price and it's appreciated significantly over the years. Maybe I received equity compensation. Maybe I've gotten a gift or inheritance that has then subsequently grown significantly from the date of gift. But regardless of how it got there, its capital gains are significant enough that deter you from wanting to sell the position. However, it does present a potential risk to having a significant portion of your wealth in that one stock. The main risk present by having more than 10%, and oftentimes quite a bit more than 10% in one name, is what's called idiosyncratic or single stock risk. What that means is while the market can drive prices up and down for stocks, you also have certain scenarios where a company has a very specific risk to them. For instance, something close to home here in Seattle, when Boeing had airplanes going down, that sent that stock quite a bit lower than where it was at all-time highs. That might have sent ripple effects to companies that support Boeing, but the larger market was mostly unaffected by that move in Boeing. So the dilemma here is I have this risk inherent with having a lot of my money in a single stock portfolio, but I also have capital gains if I were to sell that stock. Especially here in Washington, if I sell too much, I'd have an additional state tax. So I'm going to go over a few of the strategies that you could take with this concentrated stock position to help mitigate some of those risks. And then the goal would be to dive deeper into each one of those strategies with its own video to give you a deeper understanding of each individual strategy. So these strategies include, number one, a donor-advised fund, which you can open at a brokerage firm. And that donor-advised fund would allow you to move some of that concentrated stock into the donor-advised fund, sell the stock you moved into that fund, and diversify it. However, the point of a donor-advised fund is that those funds will be used for a charitable contribution in the future. So you get the tax benefit today, but those funds would have to be used for charitable purposes in the future. Very similarly, if you have enough of a single stock, it might make sense to open some level of a charitable trust to then sell and diversify that stock. This strategy would require you to bring a lawyer into the equation, but oftentimes if this strategy makes sense, my guess would be you might have an estate planning lawyer that you've worked with in the past. Another option, which is fairly simple, is you could sell periodically shares of those companies with a strategic capital gains budget to decide how much in capital gains you might be willing to take each year. Oftentimes this strategy is combined with tax loss harvesting strategies so that you're able to hopefully harvest some losses to counteract future capital gains. Another strategy would be using options to hedge that risk. Oftentimes, the most common way is to use what's called a collar on the stock, where I would set in a floor or a maximum loss on the stock, but then I would cap my upside and potential future gain. While a collar is the most common strategy, there are many option strategies you could use to hedge that risk. And the final option I wanted to talk about actually combines option strategies with taking debt out against that position. This strategy is called a prepaid variable forward. This strategy often requires you to have a significant net worth and at least more than $1 million to $3 million in that one security. But the combination of the collar to hedge the risk and borrowing against that stock frees up funds for you to be able to rebalance that position, cover other debts that maybe are at a higher interest rate. It allows you to monetize that position without needing to sell the stock and realize those capital gains. Now keep in mind this is a very broad overview and the goal is to provide more details on each strategy through each video. Also keep in mind these are very complicated strategies, or at least some of them can be, and there are very important tax considerations to make when looking at these strategies. The goal with this video was to give you a broad overview of some of the options that are available to you. However, I do not recommend you necessarily take on any of these strategies without professional consulting from CPAs, lawyers, financial professionals, advisors. The hope is that at the end of this concentrated stock video series, you should have enough information to try to make an educated decision on which strategy might make the most sense for you. If you have any more detailed questions on this topic, feel free to reach out to me, but I hope this does help you better understand some of the strategies available to you if you are someone with this problem.